It should come as no surprise that the current property boom will create a new generation of wealthy Australians. However, if history repeats itself, and it most likely will, most people who get into property investment this cycle won't develop the financial freedom they deserve. Now, why do I say this? Well, just look at what happened during the last property boom, and the one before that, and the one before that. 50% of Australians who bought a property investment sold up over the first 5 years, and 92% of those who held on to their properties never got past their second property. In fact, 70% never got past their first property. Now, you really can't develop financial independence with just one or two investment properties, can you? Recently, the Real Estate Institute of Australia released research showing that Australian house prices soared in value by more than 500% over the last 25 years. But again, most property investors failed to develop a substantial portfolio. So to help you make the most of our property markets, I've put together a special two-part series. In today's show and the next one, I'm going to share with you 40 property investment lessons that I learned in the last 40 years in the hope of evening the odds in your favour and allowing you to become a successful property investor and create lifetime wealth. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hindsight's a wonderful thing, isn't it? Let me ask you a question. With the benefit of hindsight, knowing what you know now, if you had the opportunity to do so, would you have bought an investment property 40 years ago? I bet your answer would be yes, realising the median price of a property in Sydney was around $68,500 back then. And you would have probably been happy to buy a median price property in Melbourne for just $40,000. But let me ask you another question. What if you didn't have the benefit of hindsight, and there we both were, back in 1980, 1981, and just as you were about to invest in property, I told you that in the next year or two, Australia would fall into a recession. What if I told you that in 6 years' time, negative gearing would be removed, only to be reintroduced a couple of years later? What if I told you there was going to be a stock market crash in 1987? Remember, there we were in 1981. What if I told you there was going to be a stock market crash and a severe recession in the early 90s, meaning that the first decade of owning your own investment property, your first investment property, you'd have had to face all those headwinds? Well, knowing what you would know then, would you have still bought a property back in 1980? Now, of course, with the benefit of my time machine, and you still being back in the 1980s as you plan to buy your first property, I'd also warn you of the upcoming AIDS scare and the SARS pandemic and the Asian financial crisis and September 11th and the global financial crisis and the coronavirus-induced world recession in 2020. Would you have still had the courage to buy a property back then in 1980? And the answer for many people would be no. Why on earth would I invest in property knowing there are so many challenges, so many problems, so many risks ahead? Of course, they would have missed out on some amazing wealth-building opportunities, wouldn't they? How do I know this? Well, I was already investing for almost a decade back in 1980, and I did buy another investment property that year. And over the years, the capital growth I achieved from my investment properties allowed me to keep adding to my portfolio, meaning that today I have a significant cash machine. It gives me the lifestyle choices I was looking for back then. Of course, along the way I've made some great investment wins, but I've also made more than my share of mistakes. I've learned many lessons that I wish I knew back then. So I'd like to share with you 40 of these property investment lessons that I learned over the last 40 years. The first lesson is that our economy and our property market moves in cycles. Booms never last forever, but neither do busts. And that's mainly because most of us get swept up in the optimism or pessimism of others. So don't be surprised when the booms and the busts come around, and don't overreact. This will help avoid you being sucked in by the booms and spat out during the busts. Property investment's a long-term game. It's not a process. It takes time. It's not an event. So the first lesson is the economy and the markets move in cycles. Don't be surprised when they occur. The second lesson is, despite the ups and downs, the long-term trend for well-located capital city properties in Australia is that it's always been rising. This long-term growth of property values is underpinned by Australia's population growth, by our demographic changes, by the underlying wealth of our nation, and that's allowed us to afford more expensive properties. Now, I know some people are saying today that properties are so expensive they can't keep going up in value. But I heard that in the 1980s as well. Don't buy properties, our children will never be able to afford them. But look what's happened to property values since. Over time, property values will keep increasing in value, but the dollar that you earn, the wages that you earn, the spending power of your money will not keep increasing. Look, you know yourself that if you're buying a loaf of bread today for $1, it's going to cost you $1.50 in 10 years' time. Much the same way, just properties are going to go up with inflation alone, but also they're going to go up more than the dollar value is going to. So you need to own the right sort of properties. The third lesson I've learned over the 40 years is, even though they're armed with all the research available in today's information age, economists never seem to agree where our property markets are heading, and they usually get their forecasts wrong. And that happens at this time of the year, of course, doesn't it, when people are making forecasts for the next year, the next 5 years, the next decade. You see, market movements are far from an exact science. It's more than just the fundamentals. They're reasonably easy to quantify. It's actually the overriding factor of human sentiment, of consumer confidence that sways the market. So in general, our property markets are driven by owner-occupiers, but the booms and the busts occur when the investor sentiment gets in the way or disappears. The fourth lesson I'd like to share with you is that every year we get hit by an X factor, an unforeseen event or situation that blows our carefully laid plans away. Now, I'm not talking about things like COVID. You see, every decade or so, a major event happens. The world breaks. That's different to the X factors, which sometimes work on the positive side and sometimes on the negative. The fifth lesson I want to share with you today is that there are multiple property markets in Australia. You've heard me say that before. So even within each capital city, there are multiple property markets divided by geography, by price point, by type of property. So when somebody tells you the Australian property market's doing this, or the Sydney property market's doing that, don't pay attention, because this type of information is of no use. You need to examine how our markets are performing at a much more granular level. Within each state, there are inner city CBD markets, there's inner suburban markets, middle ring suburbs, outer suburbs. There's houses, there's apartments, there's townhouses, there's new properties, there's house and land. They all perform differently. So it's important to understand how the segment you're looking at performs and not look at general median prices. Lesson number 6 is that property investment is risky in the short term, but secure in the long term. So property investment's definitely not a way to get rich quickly, even though that's what many people want, and that's what some people are going to offer you in those emails that you get that tell you that you're getting rich through property is easy. Over the years, I've found that it takes the average property investor around 30 years to become financially independent. In the first 5-10 years, they make lots of mistakes. They've got to learn a lot. They've got to pay learning fees, learn what not to do. And then you need a number of property cycles under your belt to grow a substantial asset base to give you the financial freedom you want. Now, of course, you can shorten that journey by not making those mistakes in the early years. So how do you shorten it? Get a mentor, get a property strategist, get somebody like the team at Metropole on your side to make a plan for you, because that's going to mean that you're unlikely or less likely to make those mistakes the average investor makes. Lesson number 7 is, since property investment's a long-term game, don't look for what works now. Instead, look for what's always worked. History shows that this year's hotspot becomes next year's not spot. So don't make 30-year investment decisions based on the last 30 minutes or 30 days of news. How often have we seen this in the last year or two? If you would have listened to the news In March, April 2020, there was worries about property Armageddon. Even some of the big economists got sucked into the belief that the property market was going to crash, and they were wrong. So don't look for what's working this year. Property investment is a long-term game. It's not an event. The eighth lesson I'm going to share with you today is residential real estate, residential investment is a high-growth, relatively low-yield investment class. So your wealth in property investment is going to be created by building a substantial asset base. You do this by holding good investments for a reasonably long time, reinvesting the income you're receiving, and allowing your capital gains to build up, and then you take advantage of compounding. So I know some people invest for cash flow. Cash flow keeps you in the game, but it's actually the capital growth that's going to get you out of the rat race. So I don't buy properties for cash flow. Our clients at Metropole don't buy properties for cash flow. They buy properties to be able to buy more properties. The last property I bought, not that long ago, I didn't put any money out at all. In fact, the money came from the equity in my properties, and the serviceability came from the equity and the rent in my properties as well. So you should be buying properties that grow in value more than average so that they allow you to buy more properties. So the eighth lesson is residential real estate is a high growth, relatively low yield investment, and don't try and bastardize it and make it something different. The ninth lesson is that at times of poor or no capital growth, strategic property investors manufacture capital growth through property renovations and development. So while the market will in general do the heavy lifting, you can speed things up by choosing the right locations where there's going to be growth, such as areas that are gentrifying, and I recently did a podcast on that, where the local area is growing, even though the state in general isn't. But let's speed it up by doing renovations or development. But you can't just do it anywhere, because if you do it in an area that's not going to grow well, it's going to be hard to benefit from it. The 10th lesson is that residential investment's a game of finance with some houses thrown in the middle. So what you've got to do is get a finance strategy. You should have a plan, and part of that plan, of course, is a finance strategy, not just to buy this property, but to buy the next one and the next one. So the 11th lesson follows on from this lesson number 10, and it is that taking on debt is not a problem. Not being able to repay the debt's an issue, meaning cash flow management is a critical part of wealth creation. So it's important to understand there are three types of debt. Bad debt against depreciating items, like cars and like the latest iPhone and the latest gadgets. Necessary debt, such as the non-tax deductible debt against your home. And good debt against depreciating assets, like income-producing residential real estate. So lesson 10, that investment's a game of finance, and 11, not being scared of taking on debt, are sort of interlinked. But you can't grow your wealth without taking on debt. Debt isn't risky if you know what you're doing and have a good finance strategist to help you. Not doing anything, not investing, is risky. The 12th lesson, and I've mentioned it in passing already, is that property investment is a process, not an event. So to be successful, it's more than just doing some research on the internet. It's more than just inspecting a few properties and buying one. Remember, searching for a property in your local neighbourhood is very different from research. Successful investors have a long-term strategy to grow their wealth, and they use the correct asset, protection and finance structures, as well as insurance, to mitigate their risks. They get a good team around them to level the playing field. They understand the difference between salespeople who represent the seller and the independent advice you can get from a property strategist or a buyer's agent. Now, I know a lot of people go to a buyer's agent to help them with their property investments, but buyer's agents are biased. If you saw a buyer's agent in Perth in the last 10 years, they would have kept telling you to buy in Perth when the Perth market just didn't go up. Buyer's agents only know their patch, and they're good if you know what you want to do, but they're not good at telling you what you should be doing. They can implement your plan. Now, at Metropole, we have Australia's most proficient team of buyer's agents, but we have property strategists that put a customised plan, a strategy together for you. And I believe in the challenging markets we're moving into, even though the markets are doing well, not all areas will. And that's why you need more than the buyer's agent. You need more than the property strategist. You need a holistic approach to help you grow your wealth. And that's what my team at Metropole do. By the way, I'm going to go tell you a lot more lessons in a moment, but I suggest you have a look at the team at Metropole, go to metropole.com.au and see what we can do to help you create wealth, to give you some direction, to give you some certainty, to give you safety in this market. The 13th lesson I want to share with you today is that strategic investors don't only buy property, but they buy time to ride out the cycle. And that's, again, part of having the right finance strategy, because they have financial buffers in place. So interestingly, none of our clients at Metropole last year, during the challenging times of COVID, had to sell up, because we had put a plan in place for things to go wrong. We didn't know it was going to be COVID. We didn't know we were going to have a recession. We didn't know we were going to get locked down. But remember, I told you in one of my earlier lessons that things go wrong. Every year there's an X factor. Every 10 years the world breaks. So therefore, we have a plan for that. And we, therefore, can ride through these difficult times. The 14th lesson I'd like to share with you today is that wealth is the transfer of money from the impatient to the patient. Now, I must thank Warren Buffett for that quote, but it's one that has seen me through well over the years. So rather than be in a rush, rather than look for the next get-rich-quick scheme, rather than do things in a hurry, wealth is the transfer of money from the impatient to the patient. The 15th lesson I'd like to share with you today is that the media is not there to educate you. Its job is to get you to click on their links so that they can get revenue from the advertisers. So don't rely on the media for investment strategy or advice. You'll often see how conflicting the media messages are as well. Now, I deal with journalists all day, and they're very nice people, but many of them are not investors and are not experienced, and basically just write up press releases, and then they'll find various people to justify the angle that they want to put in the media. So the 15th lesson is the media is not there to educate you. Lesson number 16 today is there'll always be somebody out there telling you not to invest in property. There's 25 million property experts in Australia. Everyone's got an opinion because they live in a house, they've rented a house, they've bought a house, but you've got to be careful who you listen to. So there'll always be somebody out there telling you not to invest in property. Lesson number 17 is there'll always be somebody out there telling you to invest in property because they've got a vested interest. And usually their best interest isn't your best interest in mind. In other words, be careful who you get advice from. So a moment ago I told you about the team at Metropole who could help you build a strategic plan to grow your property portfolio, to grow your wealth, to become financially independent. And at Metropole, we don't sell property. We never have. So we don't have the vested interest other than to help you become financially independent. Lesson 17 was there's always going to be people out there telling you to invest in property. So understand what their vested interests are. Estate agents are not your friend. They're nice people. I'm a licensed estate agent, but their job is to get the highest price for the vendor. Property marketers, they're paid by the developer to make them the biggest amount of money, not to help you. And interestingly, there are people out there who call themselves mentors and call themselves strategists when they're actually being paid by the developer. Be careful whose advice you get. The next lesson, lesson 18, is savvy investors surround themselves with a great team and they're prepared to pay their advisors. They see this as an investment, not a cost. I've paid for mentors. I'm part of mastermind groups. I've actually always found the benefit of having coaches. So while all the successful investors I know pay for their advisors, the average investor who doesn't do well ends up getting their advice for free on the internet. What's that old saying? You pay peanuts, you get monkeys. Now, I'm only going to share 20 of my 40 lessons with you in this podcast and another 20 next week. So 2 more to go today. And one is, if you're the smartest person in your team, you're in trouble. If you're the smartest person in your team, you're in trouble. So you've got to surround yourself with a great team. That was lesson number 18. But be prepared to take their advice. Leave your Superman cape at the front door when you go in and speak with your advisor. And the last lesson I'd like to share with you today, next week I've got another 20 lessons, is you're going to make investment mistakes along the way. And you're either going to end up paying a significant learning fee to the market, or you're going to pay your advisors and learn from their experience, and they're going to minimize your risk. So I've always, as I said a moment ago, been prepared to pay for mentors, pay for coaches, pay for advisors, and I'd recommend you do the same. Now, I'd love to be part of the team looking after you, so you can always look at our track record, go to metropole.com.au. We've been involved in close to $4 billion worth of property transactions. We're currently managing over $2 billion worth of assets for clients. Last year, my team won 3 separate awards as Australia's leading property consultants. So next week, I want to share with you another 20 lessons from this 40 property investment lessons I've learned over the last 40 years. I hope you got some great ideas from this. In fact, it was such a great detailed list that please excuse me if I make the suggestion that you listen to it again. Replay this podcast maybe at double speed, 1.5 times speed, because there was lots of detail there that's taken me a long time to learn, and they were expensive lessons that I've had to pay for. I hope I've helped you. I hope you learned something from those lessons today. And if you want to learn even more lessons, I've got a special gift to you, a wide range of ebooks to add to your success library. Just go to podcastbonus.com.au, leave me your details, and you'll get exclusive access to a range of my ebooks. I'll leave a link in the show notes, but podcastbonus.com.au, and you'll get a link straight away to a wide range of ebooks that you can download and read at your leisure. Now, just following on from my comments a moment ago, before I share my mindset message with you, this is a changing market that we're in, one where not all property investors are going to become successful, despite the market moving. I guess there's a couple of reasons why that's going to happen, and one of them is FOMO kicking in and people making emotional and wrong investment decisions. I'm seeing that happening a lot at the moment. People compromising their standards. They're either not doing all the right due diligence, or they're buying in the wrong location, or they're just scared they're missing out. There's lots of reasons that FOMO is affecting investors at the moment, but there's a way of protecting yourself, and that's getting somebody on your side to give you direction, guidance, and ensure you get the right results by stopping making the same mistakes that unfortunately a lot of investors are going to. So whether you're a beginning investor or an experienced investor, why not get my team at Metropole on your side? Hey, we've won another award this year already as Australia's leading property investment consultants. So why not find out what we do? Go to metropole.com.au. We've got a wide range of services, and I'd love to be part of your ongoing wealth creation journey. We give strategic wealth and property advice. We don't sell property, which means my team's advice is independent. It's structured for you. It's customized for you, starting with a strategic property plan. And then if you want to, you can use our buyer's agency, our wealth advisory services, renovations, development, property management. I look forward to being part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today I'd like to share with you a daily tool that the rich use that never occurs to most people. Over the years I've worked with and mentored many successful investors and business people, and I've found that they use this daily tool that most people never think of. Now, we've all heard about, or maybe used, to-do lists. The best to-do lists incorporate daily activities that help you move towards your goals. You've got them set out there. But to-do lists alone won't make you successful. While it's important to get things done, it's equally important to avoid things that actually stop you getting towards your goals. So you've probably never heard of a to-don't list before, but that's what you need. Now, I discovered this little-known secret of most successful people many years ago, and a to-don't list includes things you should never do because they're either time wasters, bad habits, or things that hold you back from being happy and successful with life. Now, my good friend Tom Corley has written a lot about this in his books and combined a bit of it in our joint book, Rich Habits, Poor Habits. But he also says that to-don't lists are just as important as to-do lists. And he's made a list of things that you should have on your to-don't list. He says most successful people fostered accomplishment in their lives by diligently doing certain things every day and diligently avoiding certain things. He went on to say most people, unfortunately, unsuccessful in life. They eke out a living and struggle to just get by, unaware that they're engaging in destructive activities on a daily basis that makes their own success impossible. So Tom Corley went on to say they're engaging in these activities that might appear on a typical to-don't list of a successful person. And that would say, don't watch more than an hour of TV today. The to-don't list would say, don't waste time on Twitter, Facebook, Instagram, YouTube. The to-don't list would say, don't envy anyone today. Don't make any impulse purchases today. Don't gossip. Don't gamble. Don't drink in excess today. Don't lose your temper. Don't ignore your family. The to-don't list would include things, according to Tom Corley, such as don't read negative news articles, don't procrastinate, don't ridicule anyone, don't hate anyone, don't smoke a cigarette today, and don't be negative. Now, for those who've got a lot of bad habits, to-don't lists are actually more important to them than to-do lists. And you know, in our book, Rich Habits, Poor Habits, which you can get at richhabitspoorhabits.com, we explained that people are going around with one foot on the accelerator and one on the brake. They've got a lot of rich habits, but they've also got poor habits that they've got to get rid of, they've got to break. And that's where a to-don't list will help you. To-don't lists help keep you aware of things you shouldn't be doing. Knowing what not to do, in my mind, is just as important in achieving success as knowing what to do. So, what would be on your to-don't list? When you ask yourself that question, only then will you become aware of the daily habits that are constantly pulling you backwards. To-dos, while a great tool to help you improve your chances of success, are only going to get you halfway there. To-don'ts will get you the rest of the way to your success. I hope you enjoyed the first part of this two-part special series where I'm going to share 40 lessons with you. To make sure you get the second episode of this two-part series, please make sure you subscribe to this podcast wherever you're listening to your podcasts. And if you want to catch up with me in between, you can catch me on social media. Just look for Michael Yardney, or we have a special private Facebook group where every day I share some charts, some commentary, some information that I don't share elsewhere. Just look at Facebook and look for the Property Update Facebook group. Now, remember that bonus I mentioned to you, podcastbonus.com.au, where you can get a range of ebooks. I look forward to being back with you again real soon, twice a week. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?